The internationalization of the Chinese yuan is something people have been hearing about for years. But after years of promotion, the yuan's share in global payments has only been around 3 to 4%. According to the latest SWIFT data, it has now fallen to about 2.9%. The US dollar's share is 17 times larger, and even the euro's share is about 7 times higher. It's often said that the main obstacle to the yuan's internationalization is the United States. But is it really that simple? In fact, the biggest hurdle may not be external at all. It could be China itself. Few people realize that in China, ordinary depositors sometimes have to wait weeks just to withdraw their own money. Electric vehicles exported to Europe sometimes have profit margins close to zero. There are also cases of companies wrongly claiming subsidies, and growing numbers of international anti-subsidy investigations. How do these issues connect to the yuan's internationalization? Let's take a closer look. On the surface, China has taken many steps. It has settled trade in yuan with Saudi Arabia, Brazil, and Russia. Middle Eastern countries have increased their holdings of yuan assets, and Belt and Road lending is increasingly denominated in yuan. In reality, the yuan's share of global transactions has barely improved. Foreign holdings of Chinese bonds have been steadily declining. And the so-called internationalization of the yuan remains more talk than progress. There are three main reasons. 1. Capital controls. The Chinese government is highly wary of capital outflows, to the point where even small withdrawals can be difficult for ordinary citizens. China has essentially avoided developing a domestic cryptocurrency market, because once funds enter the crypto sphere, they become nearly impossible to track. As a result, mainland residents can only participate indirectly through platforms in Hong Kong and other regions. This roundabout approach limits the yuan's flexibility and reduces its use in the global financial system. And as Beijing's oversight of Hong Kong's capital flows increases, even Hong Kong is now only relatively more convenient. 2. Non-free exchange rate. The yuan's midpoint rate is set by the People's Bank of China, limiting the ability of market players to hedge. 3. Lack of independent rule of law. Contracts are less secure, and foreign or private companies can be subject to sudden intervention. These issues affect not just foreign investors, but also ordinary citizens. For example, in 2022, the Henan Rural Bank scandal involved over 40 billion yuan in frozen deposits, affecting tens of thousands of depositors who couldn't access their money for months. Eventually, local governments repaid the funds in installments. News like this, once reported overseas, directly undermines global confidence in China's banking system. Currency internationalization also depends on corporate credibility, but many of China's major companies rely on subsidies, financing, and storytelling rather than sustainable profits. Evergrande issued bonds while losing money. NIO lost 675 million yuan in Q1, and Xpeng has yet to break even. Bad debt pressure is alarming. China's non-performing loans totaled 3.2 trillion yuan in 2023, and in Q1 2025, sales of personal NPLs reached 74.2 billion yuan, up 190% year-on-year. One-off profits can't cover such systemic losses. Between 2016 and 2020, BYD wrongly claimed 143 million yuan in new energy subsidies, covering 4,973 vehicles. And that's just one company. If small mistakes are widespread, the total could be far higher. Because subsidy audits lack transparency, official numbers may only reflect the lower bound. When this model is exported overseas, confidence takes another hit. Luckin Coffee's accounting fraud, Didi's US IPO triggering regulatory clashes, Evergrande's default on US dollar bonds. International markets value a company's ability to generate profits on its own, and once they believe you depend on policy handouts, they cut valuations and reduce investment. Chinese EV exports to Europe sometimes have profit margins below 5%, or even close to zero. The aim is not to make money, but to undercut competitors and grab market share. The EU has already launched anti-subsidy investigations, preliminarily finding that Chinese carmakers have received substantial government support to sell at a loss. If higher tariffs are imposed, this aggressive expansion model may be forced to shrink. To boost trust in the yuan internationally, Beijing has also taken some steps. By July 2025, the People's Bank of China had increased its gold reserves for 9 consecutive months, reaching 73.96 million ounces worth $243.99 billion. Gold still accounts for only 7% of China's foreign exchange reserves, below the global average, and far behind countries like the US, Germany, and Russia. But this shows the government is aware it can't replace the dollar in the short term, and is using gold to diversify risks and strengthen financial security. De-dollarization is not just a slogan. For a currency to become international, it needs market trust, stable assets, and a reliable legal system. But with locked-up domestic capital, a tightly controlled exchange rate, subsidy-dependent companies, heavy bad debt pressure, and subsidy-driven business models exported abroad that hurt brand credibility, the yuan still has a long way to go before it can seriously challenge the dollar. Unless China significantly improves transparency, capital freedom, and corporate credibility, its path to becoming a true international currency will remain a long and difficult one.